Hey everyone, it's Erich Reimer. I'm here today to discuss why and how bond prices move. For many people, when you think of a bond, you think of a relatively stable financial instrument that pays out a set interest rate, and then upon maturity, you get your principal back. And some bonds have a variety of options, including variable rate options, early redemption, calls to them, and a convertible to stock, and a lot of other relatively complex variations that make them often much more fascinating financial instruments than a plain common stock is. Common stocks usually are relatively straightforward in estimating their value in a standardized way, but a bond, because it has a lot of different mechanisms that can be utilized, therefore sometimes pricing it can vary quite a lot. Today I'll just talk about the very basics of bond pricing, uh, just to explain and set out the logic to understand why bond prices vary outside of the principle involved. The key behind bond pricing is the idea of the time value of money. The whole idea is if you have a 20-year bond that pays a 2.5% interest per year, the legal right to say the 2.5 interest in 10 years is going to be not the full value of that 2.5% interest. So, for example, if you have $1,000 bond, and so 2.5%, that's about $25 a year. The $25 a year, 10 years down the line, is not going to be worth right now $25. That's because every year between now and then, the value of that money now is more than the value of that money, same amount in the future. And the reason for that is in a normal economy, we're not talking about shenanigan everywhere negative interest rates. Um, in a normal economy, that money can be invested and can grow essentially. And so, therefore, that money now is worth more than the same amount of money in the future. And it's because of that that these bonds vary in value. So, when a bond is sold at auction or issued by private lenders and underwriters. So that bond is already as it is, and so it's priced in a certain way. It doesn't change immediately, the price. Um, the price of that bond will change based on primarily two factors. The first is the general nature of interest rates currently in the market. And so if the general market interest rates go down, for example, that bond will, from when that bond was issued, that bond will become more valuable because essentially you're able to get a financial instrument that pays at a higher interest rate than what you can get right now on the market. However, if the market interest rates go up, then the price of that bond goes down because why would someone pay full price for a bond that issues less interest than an exact same bond they could otherwise get at the moment on the market? So if you bought a 3% bond and interest rates go down 0.5%, I mean, that bond is going to be much more valuable because not only is it paying at the moment a significantly higher interest rate, but you have to count all the years in the future it still has obligated for that interest rate. So that's why one of the best returning investments over the past few years out there in the entire market are European half-century bonds. And so there are very few of those, but that takes that principle to the maximum extent because interest rates have been going down so much in Europe, And therefore, a bond issued before those interest rates went down, and when you think of all that time that interest applies to, I mean, 50 years, that's an incredible amount of time. We're not talking about a 1 week treasury note here. Then you can imagine why the market price of that bond will be much higher for someone who wanted to buy that bond right now and the legal right to all of those future interest payments, because it's about the difference between those future interest payments and the current market interest rate, and deducted by the time value of money. The other factor that affects bond prices is the credit rating or general default risk of the issuer. There's a difference because credit agencies, sometimes they aren't exact. They have triple A, triple B, AAB, et cetera. But they're not like minute prices. While default risk is essentially the minute price of how much default risk there is, or repayment risk, or whatever you want to call it. And so those can vary a lot depending on how the company is doing, a variety of factors. And so if default risk increases, the price of the bond already issued goes down because it's now more risky than it was when it was issued. If default risk goes down, then the price of the bond will go up because it's now a less risky bond than when it was first issued. And so that's just a basic intro to bond pricing. Many bond funds out there have made a ton of money over the decades, as bond rates for the past few decades have been on average consistently going down and providing this net kind of rising sea effect on bond prices. But of course, we'll see if that lasts in the future. That's the thing about the market. It's always shaky and changing, and there's many ways to modify and approximate your risk. And when playing with bonds, this is a good thing to keep in mind. And so when you see your bond fund go up or down, understand why it is doing so. And so happy investing out there, and see you all soon.